We have a special session. You met Fernando yesterday. Fernando has agreed at request to basically share some of his insights, a kind of masterclass from Fernando Murias on raising capital, which I thought would be. This man has probably done more transactions, I dare say, than anyone in the room, and so we're going to have a chance to. He's going to lead it, so if he wants to share his wisdom, open it up for questions. But we just said, please give us a masterclass on raising capital and getting transactions done to the value of shareholders and entrepreneurs. Would you please welcome back Fernando? Okay.
Julie?
Yes.
Thanks.
Something which I think not only I would benefit from is could you put together a table with the different companies that have been presented and what type of financing?
Yeah, no, well, so I was going to do that at the end of the day, but since you brought it up, let me just do that really quickly. So many of you are newbies. This is the first time young Edward Elvis has entered the room. We got him there. There we go. No, but we do that at the end of every FTE. Is not only do we do that so that you can all, you might have gotten a coffee and missed one or something like that. So you have the full spectrum. And then we create the FTE Winter SPV. Now you might decide that you want to pick off 3 or 4, or work closely and put. But we also give everybody in the group that comes together for an FTV an opportunity to basically diversify and say, I'm in for X, and X can be right. And then we diversify that, right? So the investment team, we make clear who's on the investment committee for that, and then everybody gets to participate. As part of the fun is that everybody gets to track the companies, and we quarterly report, and then as you saw with Theo, we'll plug that into our Eco Squared. So not only will we share that with you, but for people who want to participate, more than a token way, but they want to participate in the journey, and so we give them that opportunity. So that will be coming latest on Monday. We have most of that prepared already. Okay? Excellent. Fernando.
Thank you, Julie. So I mentioned to Julie at her cocktail party that I was getting a number of questions since we at DGS had raised $100 million as a pre-revenue company. And I thought she might want to put something on the agenda related to capital raising. And she said, well, thank you for volunteering to lead that. And I said, okay, so here I am. There's no slides. So I'm happy to talk to you guys about my experience and what we've done and offer some tidbits of what we've been through that maybe help you as well. So the first question that I get or that I really ask when someone says, I need money and what should I do? And really the first question is, are you really ready to raise capital? In order to raise capital, you have to really understand your business. You have to understand your business model. You have to understand your competitors, what your value proposition is. And more importantly, you need to be able to articulate it, right? So startup mode, early stage, let's face it, when someone asks you what's the pre-money valuation of the company, you're guessing. It's an art form, right? You don't have any data. You can say, look, the range is somewhere between 5 million and 30 million. Typically, a lot of the software-based companies that scale very quickly are in the upper end of that range. Companies that are product, that have hardware, et cetera, on the lower end of that range, because VCs just don't like product companies, generally speaking. And what I've found, not just in my own experience with DGS, but also when I ran M&A at PwC for the Washington region and for the East Coast for a pretty long time before doing what I'm doing now at DGS, is VCs don't like pre-revenue companies, right? VCs like companies that have a sustained track record of revenue. They've proven their model. It's not really venture capital, even though it's called venture capital. And PE firms are even worse. You have to have a revenue threshold in order to talk to them effectively, right? So as an early stage company, it's very difficult to raise capital. And once Silicon Valley Bank went down last year, a lot of the credit opportunities that were around dried up very quickly as well. So it's become very difficult to raise capital in today's environment. And so, some of the first things that we did, we ended up speaking with a number of VCs, because I think they're very smart people, to refine our business model. And for DGS, they made it very clear to us that we had too many verticals. We had 14 vertical markets. We were really proud of that, and they said it's too many. People can't process more than 5. Get your verticals down to a manageable number, be really clear, dominate them, understand your value proposition in each vertical, and be able to articulate it, right? So I always talk to early stage companies about what materials have you developed to clearly articulate your value proposition. And if you looked at Daniel's presentation, he went through a lot of the things that I'm going to be talking about very, very well in his presentation. And it's not by an error because of his experience, right? And so to be able to clearly articulate what problem are you solving, how are you different, and what's your strategy for them to get their money back out, right? And so it's not just enough saying, okay, I want to raise capital. What type of capital do you want to raise? What stage is your business in? I forgot who the speaker was earlier, but they said, I need seed money now, but I don't want to give away too much of my company because 10 months from now, I'm going to be in a very different position and much more valuable. Well, in that scenario, I like to use convertible debt because you don't have to set a pre-money valuation for the company. So you use convertible debt where you basically say, I'm going to create a note. It matures in 2 years, 3 years in some cases, people more like 2. You find out what the market rate is that's at the time, whether it's 10, 8, 10%, 12%. You can pay a PIK interest where you pay all the interest at the end. But the note is convertible into equity off of a percentage of your first equity round. You're only raising a few $1 million to get to the next stage where you can more effectively value the company. And at that point in time, you give them a 20% discount off of that value that will be set with more parameters, sometimes more professionally if you're working with a VC to raise a large amount of money. So the mystery around the pre-money valuation is cleared, if you would, or less risky for them. If anyone tells me they have nothing but a PowerPoint and an idea, and they tell me their pre-money valuation is more than $5 million, my antenna goes up, right? I did consulting work for 10 years for VCs. I led a team at PwC that did all the analysis of the companies, that the firms were looking at. And you look at a variety of different things, but the pre-money valuation is a big target because it moves quite a bit depending on the business strategy of the company. So yes, you have an executive deck where you lay out your vision, you lay out how you're better than the competitors, you lay out your strategy. But then what's your business model? What are your revenue projections? How good are those revenue projections? Are they built on a percentage of market, or are they built from the ground up with specific clients that you understand the industry, you understand their spending patterns, their procurement cycle, how long does it take to buy? If you really have a strong understanding of your market, who you're going to be selling into, you're building credibility, right? And a key part of this, other than selling to friends and family, you need to build credibility. And if you don't have sales, you build credibility by understanding your product, understanding your competitors, and understanding really who you're selling into. And the better you do that, the more credibility that you'll have. Another way to gain credibility is through proof of concepts. I've heard the term several times in different presentations. Proof of concepts are gold, especially if you're doing them with a marquee brand that people understand who the firm is, and that the fact that they're accepting your technology and a potential partnership or as a potential customer is a huge stamp of credibility. So we actually did in our first 8 years while we were building our patent portfolio, 100 proof of concepts, most of them for free. Those were investments that we made to build our credibility, but more importantly, to gain knowledge of the market, right? You rather than going right to the C-suite and leveraging relationships, you work with engineers on the ground to understand the market gaps in technology that you're going to try to fill. What's the functionality that's missing? How can you make your product more distinctive? What are they looking for? What's going to make their life easier as an engineer in the field? That's where you gain a lot of information on how to better your product, right? And so we validated our technology. We validated what we thought about the market through proof of concepts. So we use proof of concepts to better our technology, but to also gain credibility in the market, right? And we used a lot of convertible debt in the initial stages. The first 2 years of our development cycle were all convertible debt. When we graduated to equity, we used some very unique equity structures around participating preferred and a lot of bells and whistles that we put on the equity to protect the investor. And it made it de-risked for them to a large extent. We also, at that point, already had 10 patents, which doesn't seem like a lot, but if you have a tangible idea that you can patent, that you're distinguishing in the market with a patent, it gets people more comfortable, right? So unless you're dealing with professional money and they're analyzing all kind of financial metrics that you may not have, things like proof of concepts, patents, partnership agreements with marquee brands, all of these things build credibility, which is really what it's about at the end of the day. If you understand your business and you come across competently, that you really get it, people feel less risk in their investment. And a big part of that also is building a cap table and a strategy towards raising capital. You're going to raise capital throughout the phased portion of the life cycle of your company. You're not going to raise capital once and be done. I've never seen that, right? And so building a story around your capital raise and the phased development of your company. And one of the presentations, I think, very artfully talked about different phases of the companies and what they were trying to do. And how much capital is going to be needed is a very important element so people can understand what's the projected cap table, what type of dilution am I going to see in the future from my initial investment, what's your exit strategy? Are you planning on getting out in 5, 10, 15 years? How long is my money going to be tied up? What is your exit strategy? Is it an IPO? Are you going to be acquired? And having answers to all that early on at the very beginning of your company is critical to gaining credibility to raise capital. And Daniel, I don't know if you found the same thing when you were going through your cap raise, but you had a lot of the same things that I just mentioned in your presentation. So, yeah, yeah, and I find a lot of firms focus only on the technology and not the business side of the company. And when I say the business side, I don't mean operations necessarily. I mean having the financing structure, having the story on how you're going to progress from a capital structure standpoint, having the right marketing strategy to promote the company properly. I'm not talking about smoke and mirrors. I'm talking about really, you put up a PowerPoint that somebody looks like their 4-year-old made it. It says something about you as a company, as opposed to having graphics and having a story that's well articulated. Can you articulate your tangible addressable market? Your addressable market is an important aspect to an investor. What size of pond are you playing in? And many firms don't understand how to determine what's my addressable market. What's the size of the pie that I'm going after, and how am I going to get that? And what are the competitors in that pie? And the more research that you do in that space, again, the more credibility you bring to the table, which is so critical when you're in a pre-revenue environment. So I just said a lot of stuff, so I'll let you guys react and ask some questions that you might have. Yes, sir.
So you mentioned convertible debt for early stage, right?
Yeah.
So I've been hearing conventional wisdom is safe, right? Like simple agreement with future equity, which Y Combinator, pioneered and established, and I think it's become kind of a standard in Silicon Valley for very early stage investing, and it's certainly what we are proposing is a safe. Is in your experience, is that consistent? For early stage.
Not convertible, but what was the alternative? I'm sorry.
The simple agreement for future equity. So you effectively limit the amount of dilution that the investor is exposed to, because there's a cap, there's a valuation cap in the agreement, so they know they're going to get in at a certain valuation. You can vary that by agreement at the same round, so you don't need to, it's not an equity raise where you're locking in everybody to the same valuation. You could potentially have different investors coming in with different caps if you need to. But that seems to be certainly Y Combinator is doing that for all of its portfolio companies that they have, and it's become kind of a standard, and I'm wondering whether that applies outside of that ecosystem.
Yeah, no, I think that's actually a very good strategy. I've not used that vehicle. I'm talking more about pre-money valuation and using convertible debt to skirt around the pre-money valuation of the company, not to deal with the dilution issue. Every equity round creates dilution unless you have some kind of agreement to limit the amount of dilution. When you're using convertible debt, you're not setting a pre-money valuation of the company because it's too early stage.
Right.
So you're saying a year from now, maybe a year and a half from now, I'll be a lot more comfortable putting a value on my company because I'll have certain things in place, patents, partnership agreements, more market traction, and then I can support a pre-money valuation much more effectively. At that time, I'm going to do an equity raise. When I do an equity raise and I say the pre-money valuation of the company is $10 million, I'll convert your note at 80% of that value. So you give them a kicker, you give them a 20% discount, but it's on a much smarter pre-money valuation where the company's had more time to develop under the model.
Sure, sure.
Yeah.
Can I give you an observation on the safe?
Yes.
I did this last year. So a couple of years ago, when the market was frothy, safes were great. Last year they were tricky because investors wanted leads, and unless you can put a lead in a safe round, it's really tricky. It's not that it's not doable, it was just a bit tough. And then the moment we turned it into an equity raise with a lead, it immediately took off. So they're great for the right time and the right investors, but they can be a bit of a tougher sell in the wrong environment.
Okay, thank you. Yes, super helpful.
Yeah.
And I had another question. But
Yes, go ahead.
okay, the other question I had was, what's your opinion on preferences? Like, each round of investors tends to want to be first in line.
Yes.
In a bankruptcy or liquidation scenario, and that sort of displaces everybody else downwards, right? The advice I'm getting is that just avoid that altogether and never permit it from the beginning. What's your opinion on that one?
Well, I hate to use the term smart money and dumb money because I don't believe any money's dumb money. But professional money, the VCs, the PEs, they're going to want preferences. They're going to want participation on their preferred stock. So you don't want to lead with participating preferred stock when you're doing a preferred stock round. Your preferred stock by definition has liquidation preferences and things of that nature over the common. Basic preferred stock terms are good to lead with. Don't lead with participation. For those of you that don't know what participation is, you basically, if you own participating preferred stock, you get your capital back first off the top, and then you share pari passu with the other preferred shareholders and equity investors in the company based on your percentage ownership. And you can have 3x you can play games with the participation. And so I would keep your initial rounds as basic as possible, knowing that there's going to be seniority requirements for the bigger rounds that come. When the professional money comes in, they're going to demand priority on liquidation and things of that nature. And if you don't give it to them, you probably won't get the money. And so when you're doing an early stage of capital raising and you're raising money in small increments and it's very painful, which is what we did. We have 300 investors. We did I have no VC and no PEs in my company by design. I think they're very smart, but they like to take control, and I didn't want to give up any control of the company. And so we did not use any professional money when we raised our $100 million. And so we got very creative in how we structured our debt, how we structured our stock. But I did speak to, I am going to potentially raise professional money this summer if the sale of the company doesn't go as planned. And I'm ready to provide additional participation rights and bells and whistles to the stock and seniority, which is what they're going to demand, at that point. I don't like it because I think the early investors are taking risk, and for them to just get bumped out of seniority when things are going really well and the company is de-risked just because someone's coming in with a much bigger check is not really fair. That's just my own personal professional view, but you have to live in the world we're living in, right? And so you have to give some of that time. Sometimes you have to give that up to get the big check to get to the end game. Yeah.
Fernando, there is a kind of a smorgasbord, lots of different companies here.
Yeah.
Some of them are creating new markets. Some of them are disrupting. Some of them are enabling them, and so forth. It seems a common theme is that very few of them have a completely clean sheet of paper. So there's a software stack in the incumbents, and they are either building something that will just naturally merge into that software stack. And it's a question of they might get lucky and go a little bit further, get a higher price, or they might be an early acquisition, right? Whether or not they build a balance sheet or not. But they're either going to get acquired for strategic reasons early, or they're going to get acquired once they start building EBITDA and so forth, right? And there's a whole kind of art and science around that. But to what extent would you encourage people to really follow the multiples of where those transactions are, right?
Yeah.
The acquisitions in their peer group.
Yeah.
Because I see a lot of people that just don't think through, well, they think they need to say, I'm raising a big number, I'm going to get sold for a big number. And it's all custom to the industry, where
Yeah.
you are, the innovation cycle, et cetera, which region of the world and so forth, and knowing where you're going to get out and what the multiple is for your investors, even if they're not professional. People are paying attention to this is only ever going to be a 5 to 7x. It can't possibly be at 25x at this pre-money and so forth. How would you advise people to think about that?
Well, a couple things with startups you have to be ready for when you put your plan together. When you're innovative and making a market, you're going to see delays in revenue generation. Because even if you have better technology, and we've seen a lot of that in the last 2 days, inherently people don't like change. They just don't. And there's political reasons, there's personal reasons, there's a lot of reasons why companies, especially the large companies that make a difference, will resist you as a client, even though you have better technology. So you need to be prepared to go through a pre-revenue stage that's probably longer than some other companies. Now, if you're merging into an existing platform, you might have an advantage in that you can get to revenue quicker because you've got some of that build already taken care of. But I don't look at innovative companies as a trailing EBITDA multiple, valuation, because, like for example, DGS, we are pre-revenue. We just flipped the switch this last quarter from being an R&D company to being a commercialized, entity. Yet we're talking about being sold potentially for $1 billion. Well, how could that possibly be? It's because it's a technology play. It's not a trailing EBITDA play. And how do you value technology? You have IP that's easily valued in multiple different ways, but you get an external valuation on your IP, and then you decide what's a reasonable number, a percentage off that IP valuation to expect for the enterprise, right? And so, when I was looking at companies before for VCs and what they should pay, you get very caught up in a historical trailing EBITDA, trailing revenue, valuation model, discounted cash flows. We're all really good at all that stuff. But where it gets tricky and possibly more appropriate for these types of companies is, what's the technology value of the company? You don't want to just sell patents, because you're going to get a lot less value than if you sell an enterprise. But if you can articulate the business development that a company like a Google or a Microsoft can get from your technology, that's how they value you. And so a big part of adding value for your company when you're looking to exit is to create, and we've done this in the last 2 months, this is all we've been doing, creating business impact documents where we analyze the buyer and we say, this is how our technology can add value to your firm. So the first thing that happens, the M&A guys do their diligence and they give it to biz dev. Biz dev says, okay, this is how much money we can make from this technology and from this company based on our markets. And here's what we'd recommend the indicative price for the company should be. That's the process. And so don't get hung up on revenue. Don't get hung up on EBITDA. Get hung up on understanding your market and the gap that you fill if you're an innovative transformational company. That's where the value is. And a lot of companies also underestimate the value of data. Right? And so several deals that are in play now, data is starting to get valued. And there are companies that value data, that can give you an external valuation on the data that you own as a company. So it's not just your patents, it's also the data. I would suggest that you guys have a tremendous amount of data that you're collecting. That data has a tremendous amount of value beyond your IP portfolio. And valuing that as part of the overall enterprise is an important aspect to determine what your company's worth. Yeah.
Any other questions for Fernando?
Keep in mind that when you're creating your capital strategy, that you should be considering obviously common stock, preferred stock, both participating and non-participating. You should look at how you can use debt and convertible debt. You can create a lot of bells and whistles to make your debt more attractive in the market. Like for example, right now we've got a debt instrument that we're paying a fairly high base rate of 20%, and we know that that's the going market rate right now today in the U.S. for this type of entity. But we're also putting a 15% premium on it if we get bought before the maturity of the note, if we get bought this year. And so when you start putting change in control premiums, you add warrants to the deal that increase the premium of the yield on the instrument, you can end up with an instrument that pays a significant return without a cash flow detriment to the company, because you're paying the PIK at the end of the note. And if we get purchased, the buyer will basically pay off all those notes as part of the deal. So you be creative around the financing structure of the company, but you have to have a long-term vision and not just go into it, oh, I need 10 million or I need 5 million and here's what I'm going to do to raise it. What's the end game? Understand the phases of your company, be able to articulate that vision to a buyer, and what's your exit strategy. And you could say, I have no idea what my exit strategy is. Well, you have to have at least an idea. Is this a 5-year play? Is it a 10-year play? And typically it's twice as long as you think, by the way. And takes twice as much money as you thought. So it's a 1-year. So I'm happy to, if you guys would rather talk offline, I'm happy to chat with you at a cocktail hour.
Well, you're here tonight, right?
I'm here tonight, and I'm
Yep.
here this weekend, yes.
Perfect. Fantastic. Listen, thank you so much for that. Brilliant insights, wealth of experience, wisdom. And I have a feeling we'll be continuing many rounds of discussion on that. Thank you so much.